Welcome to Gilligan Co.'s Fund Research video. Today, Mick Gilligan, a partner of Gilligan Co. and our Head of Research, will be discussing one of the research team's favoured funds for the current environment. Mick, the global economy has had a torrid time over the last 5 years. This has resulted in big gyrations in the stock market. Is the stock market still a suitable form of investment?
Yes, providing that it forms a part of your long-term savings and you can withstand what could be some pretty large fluctuations in the value of your capital, I'm pretty confident you'll be rewarded for taking on stock market risk at this point in time. There are a number of points that I'd like to make to support the longer term case for equity investing, and the first one is valuation. The entry value that an investor pays for an investment is one of the biggest determinants as to whether or not the investment will be profitable over time. This chart shows the 10-year annualized returns from the UK stock market ranked by the starting valuation level. So the bar on the left shows that buying the market when valuations have been low has led to annualized returns of more than 10% over the subsequent 10-year period. The obvious conclusion from this chart is that a lower entry valuation significantly increases your chances of making an attractive return over the long term. The current valuation comparable on the UK stock market is 10 times PE. So in other words, somewhere between the first and second bars on the left of this particular chart. So although valuations are not rock bottom right now, they are in favour of the longer term investor.
How important is income to investors in the stock market?
I think income is very important. The demographic backdrop provides some explanation as to why the demand for income is so strong right now. The baby boomer generation, in other words, those people who were born in the 20-year period after the Second World War, they're now entering retirement and so have a clear need for income. The world's population is also living longer due to medical advancements, better diet and various other reasons. And so this demand for income is likely to persist for some time, and we're certainly seeing strong demand for income from our clients. One of the key ways of measuring any investment is taking into account the present day value of its future cash flows. Now, dividends from shares are real and visible cash flows that can be measured. So we think that shares generating attractive yields that have potential to grow over time offer clear value and should perform well. Dividends represent a very valuable component of an equity investment's total return over time. Let's look, for example, at the performance of the FTSE 100 index. Now, this chart shows the performance of the FTSE 100 index in blue and the FTSE 100 total return index in red, the FTSE 100 total return index being with income reinvested. And it takes it from the market's closing high level in 1999 up to early June this year. At the end point on this chart, the FTSE 100 index stands at 5,435, which is some 21% lower than its peak back in December 99. However, the FTSE 100 total return index is actually up by more than 19% over the same period, clearly showing that the compounding effect of reinvested dividends is very powerful.
But does income come at the expense of capital? Do income-paying investments tend to perform as well as non-income-paying investments?
Well, this slide shows the performance of high-income-paying stocks in red and low-income-paying stocks in blue relative to the wider stock market over the last 25 years. It shows that higher income-paying stocks have significantly outperformed lower income-paying stocks over that period. There have been spells when this has not been the case, but they have tended to only last for a few years. We view dividends as a form of capital discipline. In other words, if company management have committed to paying regular dividends to shareholders, we would argue that they're more likely to be more careful about how they spend money. We think they're less likely to waste money on value-destroying acquisitions or other activities that might jeopardize the company's ability to continue paying dividends in future.
Are there any particular investments you would highlight for investors that are looking for income but are also keen to see it grow over time?
Yes, the SPDR S&P US Dividend Aristocrats ETF is a very interesting investment that does just that, i.e. it provides exposure to a high and growing income stream. Now, a dividend aristocrat is defined here as a company that has either maintained or increased its dividend for at least 25 consecutive years. This ETF tracks an index based on dividend aristocrats listed in the US. Companies that have a very long history of maintaining dividends will not consider dividend cuts likely, and we think the management of these businesses are likely to be good stewards of shareholder capital. This ETF currently offers a 3.5% yield.
This fund is an exchange-traded fund, or ETF. Can you briefly explain to us how an ETF works?
Certainly. Exchange-traded funds are designed to track an index and can be bought and sold on the stock market, just like a regular share. In this case, the index is the S&P High Yield Dividend Aristocrats Index. This index tracks the performance of 60 of the highest yielding US companies that have maintained or increased their dividend for at least 25 years. Another feature of ETFs is that their costs are typically lower than actively managed funds. In this particular case, the management fee is 0.35% per annum, whereas an actively managed fund typically charges 1.5% per annum.
Can you give us a flavour for some of the underlying stocks held within this ETF?
Sure. This ETF holds a number of well-known companies such as Procter & Gamble, Johnson & Johnson, McDonald's. It also contains a number of less well-known but nonetheless very appealing businesses. Leggett & Platt would be an example. Leggett & Platt developed the steel coil bed spring in the 1880s. It still produces bed springs now, but also manufactures a wide range of products across residential furnishings, commercial fixtures and industrial materials. This company has raised its dividend for the last 40 consecutive years.
What are the key risks that investors should be aware of when buying this fund?
Well, I think the primary risk is the normal volatility that comes with stock market-based investments. The underlying portfolio of this ETF is diversified, so even if one of the underlying holdings falls significantly, this should not have a particularly large impact on the overall value. The fact that the underlying companies generate above average levels of dividend income also means they should fall less than the wider stock market if we were to see a more general sell-off in equities.
This fund invests in the US stock market. Does that represent greater risk than a fund investing in the UK stock market?
Well, it certainly represents different risks, but I don't think these are significantly greater than investing in the UK stock market. So in the short term, the currency fluctuation between the US dollar and sterling introduces a potentially greater level of volatility compared to a pure UK investment. However, out of all of the major developed economies, the US is demonstrating the most encouraging signs of recovery. This is likely to be helpful to the US dollar relative to other developed market currencies such as sterling. That said, many US listed businesses generate a greater proportion of their revenues outside the US, increasingly in emerging markets. So in this respect, the domicile of the company is less important over the very long term. Ultimately, this fund provides exposure to well-established businesses, many of which are global leaders in their respective field. The short-term fortunes of the share prices of these businesses will be influenced by day-to-day movements in global stock markets, but the longer-term fortunes will be determined by the current valuation and the future profitability.
And finally, how has this fund performed?
Well, this particular ETF only launched in October of last year. However, the index that it tracks has a pricing history stretching back to 1999, and as this chart shows, this particular index has significantly outperformed the US stock market since its inception back in late 1999.
This video has given a brief overview of an income-generating opportunity that our research team currently like. Should you require further information or wish to discuss other income-generating ideas, please contact your broker. Or if you're new to Gilligan & Co, contact us on the details to follow.